Want to welcome everybody. Today is our second weekly chat with Chris of 2021. You know, every week we do a topic, things that are relevant, current. So I thought it would be a good idea because everybody's asking, where's the market go? And, I want to start with, I don't have a clue. As a kid, and I actually went out and purchased a Magic 8 ball. And, just when somebody asks me a question as a seer, I don't know. But there are things that you can look at to dismiss some of the noise that we're constantly inundated with from the talking heads. So when we're looking at data, we have to sort of, interpret that, and we can make, reasonable assessments on direction. And you're going to see the reason I wanted to do this topic was because about a month ago, I did a topic on contrarian theory. And you'll see me touch base on that on a slide here coming up, how that could be interpreted as it relates to some of the positive indicators that we're going to see here. All right, so without further ado, 2020 was an extraordinary year, right? It was unlike I think any of us had expected. We were caught a little bit off guard, and that does not take away, though, from the reality that we have been in a secular bull market. That means that things have been going from the left side of the chart to the right side of the chart. And you'll see that next week. One of the things I do is a market update every month, which is going back and looking not only as a month as a whole, but the year as a whole. And we will continue that trend. But this is a little bit different with some of the indicator because there's, this upward trend is being underpinned by three trends. The first is low interest rates. When you're in an extended period of low interest rates, when adjusting for fair value of the S&P, stocks are showing massively below their secular potential. This secular tailwind will not turn hostile towards stocks until they cross over. So the blue line is saying, hey, this is where we are, and it's not until we cross over the red line, which is a far way away, that we will start to see. That will be one indicator that will cause us to pause. The second is stock buybacks. Corporations have for a long time now been buying share and accelerating share buybacks. And when this is happening, this is a positive sign in the economy, right? And the third is something called the autonomy economy. And what this is innovative technologies or disruptors, as we call them, right? So there's a lot of, just think about how the economies have changed and things that are being promoted now. So whether it be immunotherapy, gene editing, robotics, electric cars, so, battery systems, things of that nature. And that seems to be accelerating as well. So innovation is something to keep an eye on as we look forward into the economy. But so as we see here from the left to the right, we see an upward trend. So although we had a quick drawdown last March, that was a cyclical bear, and it was caused by COVID, right? But overall, the economy still seems to be pointing, and this is a tailwind moving, show that we will probably continue in this direction. However, with the cyclical recovery, part of this has been influenced by heavy global monetary policy, right? Just an infusion of cash into the marketplace and into society. Now, when, things like we have a correction like we had last March, typically we're going to start to see that continue about 2 years into that drawdown. So, the average has been about 40%. And we're going to probably, you'll see that our charts are showing this will continue an upward trend probably until about the third quarter of this year. So history's take on 2021, we see this upward trend. You'll see some volatility, ups and downs, news, anything could throw this into a tailspin. But right around August, September is when we could see correction. And again, we don't hold a crystal ball, but these are indicators that our research departments are looking at every day saying, hey, where do we think the market's going to go to? Typically when a recovery is in place, it typically, and this falls right in line to about 15 months from when the recession or the correction happened, which again, last month, 15 months from there, we'll put it right around June, August of this year. So, just put that in your calendar, look at that. Let's start to, I've sent out emails about, is it time to take risk off the table? We've made adjustments. We'll dollar cost average back into the market, work with an advisor to help you to sort of navigate these waters. So we're not making emotional decisions, but we're making good, sound, at least data oriented decisions. So now risk, right? So here's the thing that could pose or throw a complete curveball into everything. And that is good economic news. Yeah, you heard that correctly. Good economic news could actually be and cause a correction to start to happen. And part of the reason is this goes back to, and I said I would show you some slides on contrarian theory, right? The market is already optimistic, right? Everybody is saying, hey, you know what? I'm making money. My 401k statements are up. My brokerage statements are up. My account balances are up. And it's, if you recall from when I did the contrarian theory, I talked about the shoe shine boy, and how, when you start to hear things on the street, getting investment tips on the street, it's time to maybe start to go and maybe deleverage a little bit. But that combined with too much optimism gets added to what's already high could be a problem. It's just, again, it's an indicator. It's something that we watch. Think of it sort of like a pulse check, like you've just run and now you feel in your pulse and you're taking it. It's just one of the things that we look at to make sure that we're not overly exposed to too much risk in the marketplace. Inflation is another area that could get triggered, right? So, when huge amounts of cash get introduced into economies, what starts to happen is that starts to put upward pressure on interest and borrowing rates. And right now, where interest rates are at all-time lows, the only place for interest rates to go into the future is up. So, we see the supply of treasuries that have come out. It's just they've been flooding the market. And that's why you'll see in the charts that I've shown, the flight to, treasuries, both midterm and long term, and then even gold, right? It's just indicators that this could put upward pressure on interest rates, and that could cause the economy to decouple. Now, there's something called mean reversion. Mean means averages. So once something, crosses over an average, can be another indicator. So we see, and this falls right in line with the 10-year treasury, typically when treasuries drop by 1% or more, you will see a reversal. And we don't know where they're going to go, but they have fallen about 1% recently. And so if that's the case, does that mean now that higher interest rates are on the horizon? Again, question mark there. We don't know, but it's an indicator. Now, you'll see here that, growth versus value. And when growth are outperforming value stocks, right, that this can be also a means reversal. And we think that we're seeing a heavy pressure there, which could cause concerns. So that's why our timeline is towards the third quarter of this year that we'll see some correction. And then lastly, the US versus international. US is outpacing the rest of the world, and we're really extreme high. So again, what goes up can turn around and collapse. So keep that in mind. Now, concentration, right? So when there's a lot of concentration into the market, you'll see that there's usually a spike in volatility, and both of these are very high. Volatility, I think we have come to, as a society, to become accustomed, right? If you've gone back to, I don't know, Black Tuesday, market drop of 400, 500, 600 points, people were like, literally the sky is falling. Now we've seen last year, we saw swings of 1,000 points in a day. And, 600 points, typically the water cooler advice is, don't worry, it always comes back. What are you worried about? So, there is a lot of volatility, and the volatility is all-time highs. And, volatility actually can be utilized to be your friend, but your portfolio has to make sure that it's aligned with your investment goals and risks. So lastly, the market summary, and then we'll wrap this up, right? So, 2021 in the market ranges. So typically, strategists on Wall Street will typically predict where they think it's going to go. And we like to sort of provide ranges, right? So in bonds, treasury issuance and, is extremely large. We already know that. 10-year rates could show a mean reversion. But the range, we think that the 10-year range is actually going to see higher yields going forward, right? Because of the amount of cash that's going in there. Stocks, on the other hand, recoveries will continue into year two. You could run out of steam mid-year. That's what we're talking about, mid-year. So we'll take June, July, August as the chart was indicating. And we think that a range between 32, 34, and 4,200 of the S&P is something that is probable. And then, so ultimately to wrap it up, opportunities and risks, right? So remember, good economic news could actually be something to be wary of. Several mean reversion scenarios could play out. So there's multiple ones there that could trip, or a combination of could cause a stumbling of the economy. And then stay aligned with the dominant secular conditions, right? So as we're looking, as we're investing, as we're putting money into the future, you have to sort of internalize, hey, what are we trying to accomplish? And do we want to keep, you don't want to have emotional reactions. You don't want to panic, but you should be working closely with your advisor, whether that's me or somebody that's on this call that's invited you on this call, or somebody that you have confidence in their ability. But, if you're doing this yourself, now might be a time to start to reach out to somebody that has skill sets and has a team behind them to help you to sort of evaluate what you're currently doing. So I'm Chris Lester here from Professional Planning Services. Join us next week, and what we're going to do is do a market recap of December. How did 2020 end up? We all know, but looking at what I found when I was building out the data was that 2020 was actually a pretty good year in the end of the day. And so, that upward trend, we want to make sure that we take care of. So as I gave advice to say, hey, let's take some risk off the table. Now let's have measured reentry back into the economy to help make sure we preserve, or at least take advantage of yield and upward trend. So I want to thank everybody for being on the call. If you have any questions, either direct them to the person that invited you on this call, or to me, send me an email, Chris at Professional Planning Services. Always happy to help. These are our disclosures. And again, we want to thank you. I'm always a phone call away. And again, I try and keep these calls short, pointed, stimulate some thought, maybe some questions. Reach out when you have an opportunity, and great seeing everybody. Have a great night. Bye-bye.